Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Excellent. Okay. Excellent. Good morning. Welcome to the beginning of the second half. So this is the MAAM research meeting. Thompson Thrift is actually one of our newer residential development players. They're quite a big one. And I'm just going to be taking you through some of the projects that our investors are involved with. These are sort of development projects. So the pictures that I'll share, it's sort of light on technical details, more on location and pictures today. And then a brief version of charts of the week. As always, we just draw your attention to the disclaimer here, so have a look. Okay, so Thompson Thrift is in their 40th year of business. They did close on their latest multi-res development vertical in late February, and so capital is starting to be drawn. In terms of the location, this is, by the way, a shot of the NCREIF property index. And I didn't put specific addresses in these slides, but all of these are within the U.S. South, and this is all Class A, mainly luxury product on the multi-res side. So the first one is the Metro. Again, this is a pretty good rendering here, and it's going to be a 4-story high-density apartment building that will be leased up fairly soon. Looks pretty nice, so hopefully we get to do a property tour. The next one is called the Classic. I think if you zoom in on this one, you can clearly see that these are computer-generated images and not, an actual building. But the idea here is this is a 3-story garden-style multi-res, 12 unit per floor, kind of town development. This is sort of classic, Class A multi-res. We have a ton of these, and we've just added to it more on the development side. The development side is a little bit riskier in terms of commercial real estate. It's also kind of earlier on in the value creation curve, and with Thompson Thrift, this is like their 9th fund or something like that, and they've been doing this for, like I say, 40 years. This is the Select. This one really looks nice to me. I lived in a part of Ottawa, outside of Ottawa, called Canada for a little while, and I was kind of in a place like this. It was expensive, but you get what you pay for. I find that when you're paying through the nose for real estate, you're usually in good company and in a reasonably safe, nice neighborhood. So that's Thompson Thrift. As these places get developed and built, I'm sure I'll have lots more to share on that, including the performance of the buildings. So stay tuned. Lastly, this is the Luxy. These are luxury townhomes. So actually, I think there's one more after this that's really nice. But I do like these, kind of townhome deals. I mean, if I was, single, I would 100% live in one of these. And then these are the villas. Again, I believe we were talking about this offline. This one's outside of Vero Beach in Florida, which, for the time being is probably actually cooler than parts of the greater Toronto area. These are high-end singles. And so, these are not for little guys, but the thing with luxury product is, sorry, let me just go back. The thing with luxury product from a commercial real estate perspective is you do kind of have more, elasticity. Sorry, I just got a call here. You do have more kind of elasticity to price movements because, the tenants in these buildings, if you dial up the rent on them, they're not going to really notice it as much. And our experience with a lot of Class A multi-res product is that you really, really had to dive into the individual buildings to find negative rent growth, and when you did, it was quite small. So there's certainly been a setback in commercial real estate in general, but the top end of the market, you notice it a lot less. So hopefully I'll have more on these. Okay, so Andrew is just really talking about this 73.50 pivot zone. As long as the close from last Friday holds, he thinks we could go higher. A breakdown through that low will test the 7,000 mark. So we'll see how that goes. Just really quickly here, zipping through the slides. It seems as though the S&P 500 was kind of bouncing around like a Plinko chip in between that essentially 50-day moving average and the first standard deviation above that. So essentially from being neutral to slightly overbought in the last couple of maybe weeks. And then this KISS zone, again, right around 7,000. That's not really an issue right now. He's saying it could be if again, 72.5 doesn't hold. So we'll see. What he was saying in the write-up of this kind of zone here, there's a couple of lines kind of converging on each other. And anytime this happens, you could get a breakout, one way or the other. So we'll have to stay tuned to see what that's all about. But from sort of a longer term perspective, the S&P has failed to, I guess, really follow through on the breakout or breaching the upper trend line here. So it's not really negative. It's sort of more like it's less, unanimously bullish, I guess is the way you could call it. Fortunately, we're in July now, and according to seasonality analysis here, which I do give Andrew a lot of kudos for blending, tech with fundamental and other forms of analysis. He does think that July could be pretty good for stocks. This chart's a little bit harder to see, but July is one of the better months to be in stocks. So I don't know if that's the sell in May and go away and then come back in July. I'm not, I don't know enough about that, but it looks pretty positive in terms of July. The thing that's a little bit trickier to get a handle on is you've got this divergence between two fairly popular technical indicators in terms of the New York Stock Exchange, and that would be the advanced decline line, which is kind of the most, I would say, market cap agnostic indicator. It's just literally a it's like if you take a bunch of school children at the beginning of the soccer field and they have a race to the end of the soccer field. It doesn't matter whether the big kids are faster than the small kids. It's just the number of kids that get there. And the problem with that is that the percentage of NYSE stocks above their 50-day which is more kind of momentum based, is kind of diverging away from that. And so that number now 56, which is more in that neutral camp. Small caps, we've kind of, I guess, played around with small caps. There's this rising wedge going on in the Russell 2000. I don't think small caps really like higher rates, particularly on the kind of mid to long end of the term structure. And so, this upper band is acting as sort of a cap. Small caps are becoming less and less of an issue for us because we did redeem a pretty good chunk of our small cap exposure a couple of months ago now, might be several months ago now. So, I think we tried to get some of our money back, and we just again felt that we didn't need the volatility. So that's it.
Appraisal short report Thursday, June 2nd, 2020, July 2nd, 2026. This is obviously a short biased report, but I am going to present some data here, which I think would lend itself to having a short bias. S&P 500 again still extended above its 200-week exponential moving average, which we can just see here visually. When we're up at this level, typically that doesn't mean that we have a lot of immediate upside from here. We pointed out this before that we've now been consolidating effectively for about 7 weeks now, up at this 7,500 point level. And as I pointed out before, when we have this consolidation after a nice strong rally, typically what that means is that there's not a lot of immediate upside left, although given where we are in the market, who knows? That being said, I'm taking another look at credit spreads here. So this is the ICE Bank of America US High Yield Index Option Adjusted Spread. And, just a couple things to point out here. The first is that unfortunately, we only have 3 years of data going back because as of April 2026, the Fed no longer provides this data going back historically only on a forward basis. It only provides data up to 3 years, which is a little odd. But what we can see here is that anytime the spread gets down to this level just above 2.5%, typically there's not that much upside left. I mean, we can see here in late 2024, early 2025, that was before the tariff tantrum, we saw a move higher. And then late 2025, early 2026, when we didn't have much more room up here, we traded sideways effectively before coming down. And so that corresponds to that same level. And we're back at this level again. And again, we're back at this level here where we have some consolidation. So on a balance of probabilities, I would say that given these two factors, the immediate material upside from here might be limited. And again, longer term, another thing to point out is that the CAPE ratio, we're now at .com levels, right? Rather elevated here, and we're starting to get parabolic with the move as well. Defense versus growth, same sort of thing. This metric is now at .com high levels, which is the highest it's been in 25, 26 years historically. And so we're essentially on a one-sided trade towards growth rather than defense. Market breadth here, we're moving higher towards this sort of red zone limit, which typically doesn't see much more upside from there. So, I don't think that, I'm not forecasting a material collapse or anything, but I think that at these levels, if we were to get up to this level around the red zone, then typically we would have limited upside from there. This is the 200. This is stocks trading above the 200-day exponential moving average. So again, not at these extreme levels, but getting there. And so I think we might broaden out this rally a little bit before anything material happens. So again, just to summarize here, we have the S&P 500 extended above the 200-week exponential moving average. Credit spreads are narrow and the same levels that we've seen before. Sell-offs, CAPE ratios at .com levels. So is the growth versus defense ratio. And market breadth is approaching limits, although not there yet. So if this picture is of a concern to you, any of our viewers watching on YouTube, it's important that you can prepare for the inevitable. We have a solution with our partners at Universa. So if you would like to learn more about that, you can reach out to us by email or any other way. So that's it from me.
Okay, here we go.
Hello and welcome to our morning update for the week of July 1st. My name is Jamie West. US futures mostly lower this morning. The NASDAQ 100 leading way to the downside, down about 58 basis points. The S&P 500 futures down about 27 basis points, and the Dow down about 36 basis points. Precious metals and crude oil also lower this morning. Today marks the first day of the new quarter. U.S. equities finished the quarter in strong fashion. The S&P 500 up 80 basis points yesterday for its second straight day of gains. Technology once again outperforming the broader market as the iShares Semiconductor ETF SOSX gained more than 4%, and the NASDAQ 100 was up more than 1.5%. SOXX returned to a buy signal yesterday with a double top break at 640, now sitting just below the all-time high it reached earlier this month at 650. For the quarter, the S&P 500 finished up nearly 15%. Technology stocks outperformed as the NASDAQ 100 was up more than 27.5%, and the iShares Semiconductor ETF up almost 95% in a blistering recovery from that first quarter sell-off. Small cap stocks outperformed their large cap counterparts as the Russell 1000 the Russell 1000 index was up more than 21%. International equities were also up, although the difference in performance was pretty stark. The iShares MSCI EFA ETF was up a little under 7%, Meanwhile, emerging markets up a little over 20%. It's a pretty stark difference between international developed and emerging markets over the last quarter, and that's produced a pretty significant relative strength difference that we see currently, with EVA sitting about 3.83 on its fund score, while EM is sitting at a score above 5.5. As you can see, it was not a good quarter for commodities. Gold down more than 13%, silver down more than 20%, and crude oil down more than 31%. Silver and gold are now negative for the year, and at about 60% at one point this year. So a pretty significant decline for precious metals. Silver now down more than 50% for the year. I'm sorry, more than 50% from its high, and down about 15% for the year. Meanwhile, crude oil fell below $70 in the last couple of days, now sitting at $69 on its point and figure chart, and has given back virtually all of the gains that it saw following the outset of the conflict back in early March. So overall, a strong quarter for U.S. equities and international equities, pretty weak for commodities. And over the last day or two, seeing U.S. equities climb higher, led by semiconductors and technology, as we saw a pretty significant gain for SOSX yesterday, adding more than 4%, and now closing in on a fresh all-time high. Has only been a couple of days since it hit its last all-time high, but still seeing that strength out of semiconductors in the short term, kind of leading this rally that we've seen over the last couple of days. So that'll bring me to the end of my review. And we'll be back tomorrow to update you on what's new.
Yeah, I don't know if I like the new format, but it is what it is. I'll come back to this playbook later. You might not be able to see it, so let me share my other ones now. I'll still use the, actually no, let me take 1 minute here and get the latest morning coffee that just came in. Okay, so I'm sort of repeating what he said, but I've got some year-to-date numbers now to the end of the first half of the year, and venture cap and India, the only two negative around the world. And you've got Canada approaching double-digit returns for the year. That also would include the commodity challenges that have happened. So there's other parts of the index that are helping there, as there will be in our portfolios. The US, you've got the NASDAQ leading. And then in Europe, you've got Japan is the huge winner at up 40%. Wow. You'd think all that raising of rates and that would have had a real problem, but that's just showing the amount of inflation in the system, and the stock market's trying to keep up with that. Crude oil is up 32% year to date, but the monthly and the weeklies are very weak. So yeah, it's come off quite a bit, as that last chart showed, as has nat gas. There's gold's negative for the year of 8% and 16% for silver. He had higher numbers, but he was going from extreme highs to extreme lows. So that's as if we can buy at the top and sell at the bottom, which I guess you can do, but don't really want to. And copper up over 5%. And then on the, I'll cover these as usual somewhere else. And there's Bitcoin. Look at that, down 31% year to date. Sean Cumbie's away today, but yeah, I've been speaking with him, and yeah, it's still in a waiting pattern here to bottom out here, but I'll cover them in a second. The insider came in recently. I've not covered it yet, but I'll just share with everybody some pretty pictures. And so he's going to talk about when the fuel runs out, promised and delivered. SpaceX, unbridled fraud. Okay, that'll be a good read. more fraud, big tech style, the AI reckoning, marking to market, markets over time, puts on semiconductors. Well, it probably looks like they're about to break out again. Foreign influence still not opening, according to him, although I think ships are getting through, but you don't know what to believe anymore. Hydrogen dreaming again. And then Exxon, something going on there. And then those are his 5 picks. So take a look at that. I was going to go through Raymond James, the Open, but we basically have everything covered. Okay, so yeah, so as always, the Canadian dollar, start with that relative to the US. It's at 70 cents, so it's been down a little bit. And it still measures further down to 69 in the short run and 62 in the long run. So nothing to worry about there. Sorry, the US dollar spot index. Now that's a change. It's slightly up to 101 now, but it measures up higher now to 109. So it looks like there's money flooding back into the US dollar spot index, up 3% year to date. So that the whole oil trade has changed things for that, where it looked like some of the world was starting to trade oil in non-US dollars, and that's now back to the way it was beforehand. Currency wars are real. Okay. Here we go. Crude oil at 68.58 and measures up to 82. So that's a new target for it. It's up 19% year to date. Nat gas measures up, and whereas the producers don't. Copper off, then uranium sort of flat. Gold, so this is interesting. Gold is at 4,000 both in the futures and the spot price, and both of them measure up to 4,300. So things will be changing there. But meanwhile, the producers, the majors, this is a difference here. So the majors, according to the Gold Bug Index, measure down, whereas the Van Eck majors measure way up, but the juniors measure down. So there's change going on here. That's all you can say. Silver looks like it's bottomed, except for the producers. So you sort of just stand aside right now for new money. We're not necessarily buying right now, but we'll dip our toes in deeper later. As I was saying earlier about cryptocurrencies, Bitcoin is below 60,000, measures down to 22,000, down to 32% year to date. Just carnaged here. Same with all of them. So Ethereum's down 45, Solana down 37. The index itself is down 35. So it doesn't really look like a bottom has been put in yet on any of these. So we'll just have to wait it out. We don't own very much of it, thankfully, and we're definitely in the crypto winter right now. The banking, the majors in the US look flat. The regionals measure up, and the Canadian banks look very strong here, up 30% year to date. So lots of wins been happening there. The dealers also look strong in the US, broker dealers. And now finally finishing off with interest rates, and then I will pass it back to Ken. Got the 2-year at over 4% now, measures up to 5 3/4. The 5-year measures up, the 10-year up, and the 30-year big up to 6.2. So the yield curve really isn't changing. It's pointing straight up now, and yeah, so that's really more of a normal economy supporting that, except for inflation is still stuck in the system when you see the 30-year pushing up so much higher. And final comment here, the VIX. VIX looks like it's going to be calming down here. So you could see the market starting to do some more positive things and going to higher highs. That's it for me.
Awesome. Okay, so I'm just going to share my screen after some tech issues, and I think I'm good. So a little bit different this week, just with the holiday. I have on Tuesday some of the normal slides that I go over weren't available, so got a little bit of a different blend this week, but nonetheless, Canadian disclaimer for our Canadian investors, just take a look. Not recommending any securities here, just contact us if you have any direct securities questions, or US investors, this is our SEC disclaimer, same thing. Now, just looking at the asset class rankings that we look at every week, big change in the commodities, obviously, with a big pullback in energy and precious metals in the recent weeks. Precious metals, obviously, more of a mid to long-term play where they pulled back kind of all year since peaking in February. Energy more recently has pulled back, obviously, since the peace deal has been announced. Within the currencies, US dollar continues its appreciation. There continues to be rotation into currency. You can see at the bottom there, currencies, fixed income, and cash really gaining strength as major asset classes this week, but also in the past few weeks. Up in the sectors, a lot of changes in the size and style, but I'm not really going to talk about those right now. Obviously, you can see value is way out of favor with the bottom three being value, and growth and blend kind of making up the top six there. But I wanted to look at the sectors. Healthcare and financials jump, communication services, which is interesting. More of a growth sector and communication service with a bit of a pullback this week. Obviously, a bunch of names have pulled back pretty substantially, including Microsoft, but that's more of a technology name. About, I think it was down 18% in the month of June. I mean, you blink and you missed it, unless you're a large shareholder of Microsoft stock. And then energy, large pullback as well, and basic materials pulling back even further than it has over the past few weeks. So continuing to see this rotation into number one, risk on assets, semiconductors, AI, anything in the AI trade. But then number two, more defensive names, healthcare, financials, utilities. We continue to see strength in a lot of those names that we're looking at. And the other risk on sector I'd say that's kind of churning along is a lot of the industrial names. A lot of them are tied to the AI trade, and we continue to see flows there. Now, I wanted to talk about the sector strength map. You can see here, this is a interesting chart from the Dorsey Wright platform from NASDAQ. You can see on the bottom, this is a relative strength buy signal total. That's as of the start of this week. And then X column is short-term strength on the vertical column. You can obviously, it's no surprise that the leading sector, industrials, like I mentioned, but also the defensive names that I just mentioned as well. But you can see tech starting to weaken, some of that breadth kind of disappearing. Communication services, just like I mentioned, weakening. You can obviously, no surprise, basic materials and some of the staples a little lagging. But you can see some real improvement over here in the consumer discretionary right now. So kind of a mixed bag when you look at these sectors and how they've been performing and looking at the overall economy. Now, looking here, this is mega caps. This is the rolling 3-year excess return of mega caps over the rest of the market. You can see the 3-year excess return is now down from 85% to 35% in just a few months. Completely disappearing. Obviously, a lot of that being led by hyperscalers, or not the hyperscalers, excuse me, semiconductor companies, anything to do with AI infrastructure, really leading the market. Obviously, you got the likes of Micron having crazy runs, SanDisk, basically anything to do with AI really doing well. And you get this disappearance of where the market was being led on a 3-year basis by these mega caps. We've mentioned it before. Not as much the story anymore. A lot of those names really kind of having some difficulties. And I mentioned Microsoft as one, but also if you look at Meta and some of the other names, there's some struggling there. Here's the chart, just a technical chart that looks at the S&P 500 and participation, which are diverging here. You can see on this chart, this is the bullish percentage chart, 1 month moving average in the S&P 500, completely diverging. Interesting happens. That happened in, or obviously early or late 2024, but also in 2021 in the opposite direction. So something to watch there. I was on the call in listen mode working on my tech issues, but I heard talking about crypto earlier in the call. Obviously, there's some crypto investors that call it the crypto winter when it's the depressing time, I guess, in the crypto trade. Obviously, we're kind of in that. Bitcoin suffering. Interesting enough, despite the AI trade in full effect, this risk-on focus from investors is not leaking into crypto. It's not leaking into the likes of strategy. It's not leaking into these crypto-based assets, Coinbase, etc. There's no flow. There's no momentum. You can see on the right here, this is the iShares Bitcoin ETF fund flows, about $3.1 billion in outflows in June. So really seeing weakness there. Perhaps there is a bottom that we can try to time. We aren't obviously crypto traders, but for those on the back end of the call, perhaps there is. I would say there's no entry point right now, just based on the pure technicals. It still continues to look weak. Obviously, Bitcoin's not the only asset that has been struggling. Gold, obviously, sharply pulling back from its record price. Momentum really ran out in the precious metals. Investors are really rotating back into US dollar right now, or the start of the year amidst uncertainty, taking some profits. We still think the price of gold does have some upside, but on the technical charts, not looking great right now. I think there's more upside in the miners right now than the spot price, just with their all-in sustainable costs being so low right now. And there's some really attractive valuations with the pullbacks we've seen. So really watching that. Now, this is a chart from Bloomberg and the World Gold Council that published this. And it's just tracking central bank and private gold allocation, private investor gold allocation. Both of them are at 30 and 40 year old. They're at multi-year highs. You can see in terms of central bank gold reserves, that's at a 30-year high. Gold allocation by private investors, that's at a 40-year high. Now, it's substantially increased. Obviously, there's investor interest. There's central banks who are interested to hedge uncertainty. This whole article where I read this in was talking about momentum, which typically changes quarter by quarter, obviously driven by investors and their models and allocations. But the strategic allocation typically change in the strategic allocation of a portfolio, especially large portfolios, often take years and even decades to adjust. So we're seeing this slow increase. Obviously, it's a gold newsletter. They're driving to reach potential previous highs. Do I think we're going to reach that level? No, but can it potentially double from here, where you're at about 50% of central bank reserves? Maybe. I'm not exactly sure, obviously, but I think there is some strong demand, which creates a bit of a floor price for the price of gold from here. Like I mentioned, miners, you can see here, this is the chart. This is the actual ETF that we own in our relative strength platform. It's just the TSX gold miner index, excuse me. It's down year to date. Technically, it doesn't look great, but on a fundamental level, looks really attractive compared to historical times. You can see also there are a number of nice lines of support. We're back at kind of prices that we saw last November / last December, and that huge run to start the year kind of disappeared. And we've obviously pulled back into kind of a support zone, we'll say. Looking here, this is just a interesting chart I wanted to highlight. Just talking about the regional breakdown of the 2025 global energy system. Obviously, Canada, the US, and Western Europe often the ones pushing the renewable hydro, nuclear, not as much nuclear, but hydro and renewables. And you can really see that these two areas are unsurprisingly the largest users of that energy. But when you really look at it in the grand scheme of things, when countries like China and India are increasing their coal usage and we're offsetting that with some renewables to try to offset our carbon footprint, in the grand scheme of things, it's not doing a lot, to be frank. And I think obviously we're at a relative disadvantage in terms of energy prices sometimes compared to those countries. But it was just interesting to see this in a global context, to see how every region's energy breakdown was. And the one that is obviously very nice to see is an expansion in that pink, which is nuclear, where we're seeing a bit of an expansion in North America, a little more in Europe. Countries taking more of the French view on nuclear power, which is great for our view and in investments in that area. But we are also seeing a tick up in other regions, including Asia and South America. So we're going to continue to watch that. Now, just saw this from Azuria Capital, which is the guy who used to work at Crescat. This is looking at copper. You can see all the copper which has ever been mined, 700 metric tons. The copper required over the next 25 years to keep up with about a 3 to 3.5 GDP growth rate, and all of the electrification, or sorry, it actually does not include electrification entirely. So adding all the EVs, grids, and AI, there's an estimated 1,100 metric tons extra which will be needed. So we'll have to see, obviously, if that comes to fruition. Huge bull case, I think, for copper in the short to mid, but also long term. Prices have obviously performed pretty well recently. Some of the miners trading at a little more elevated valuations compared to historical averages, but really a really strong case here, especially with all the money that countries and companies are going to continue to invest into the grid, electrification, and rotating how obviously the energy system is built, but also AI and a number of other use cases for copper. And this is the price of copper. Price target about 540 right now, which is a little bearish. 8% year to date, oversold the last 2 weeks. You can see probably a good entry point here, but we'll have to see if it reverses off this support line. But a really strong support base in that 530 to 545 range. So if it does pull back to there, I would really look at perhaps adding some exposure. Obviously, that is the physical metal. We do not own any of that, but still a good gauge to watch. This is just looking at household ownership of equities and mutual funds by, I think it's data compiled by Citadel and GMI. As of June 2026, the bottom 50% of equity and mutual fund holdings. So this is in terms of the level of wealth. You can obviously see the navy blue is the top 1% of Americans. This darker blue we'll call, or whatever, darker royal blue counts for the 9%, the next 9%. So the 2 to 10% of wealth in America, and then the light blue, the next 40%. So you get that 11 to 50, and then the red is the bottom 50. Interesting enough, the bottom red, so the least wealthy Americans are actually seeing their ownership of equities and mutual funds grow at the fastest rate ever, to a record high, obviously. That is coming. That's a benefit of, obviously, the democratization of financial markets and giving access through low-cost providers like Questrade and interactive brokers. And I think that's a really positive thing, obviously. Obviously, they're never going to catch up in terms of the top 1 percentile, but it is a good thing to see if they're saving in the right way. Whether it's an employee matching program or it's self-directed into low-cost index funds. We're obviously not advocating for retail investors to use their investment accounts like a gambling account, but it is good to see that substantial wealth creation, even in the lowest income areas. And then I think this is the last slide. So like I said, kind of a different style this week, kind of long in terms of the sector spotlights and looking at subsectors, but not some of the typical information that I go over. But this is the change in sector allocations in private credit from 2012 in the darker green to 2026, the lighter green. You can see the change really being driven by tech. It went from 7% to 23%. 23% of private credit right now is tech. Software is going to be a huge component of that. I think there could be some more issues within that private credit sphere that we've seen. Obviously, every month and every quarter, we're continuing to see gates up, redemptions being slow, and markdowns in a lot of these funds and these investment vehicles. So we're not in any of them. We continue to watch, especially as we're looking to launch our private debt fund this summer. And with all that, that's it for me. So I'll pass it back to David.
Great, Ken. I think we're done.
Awesome.
Definitely summertime now, so be a little quieter. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.